If you were born before 1959, there's a quiet change rolling toward you in 2026, and almost nobody is warning you about it. So right now, thousands of Australians are drawing less age pension than the law actually allows them. Not because they have too much money. And the thing that decides your pension isn't what you think it is. Stay with me, because before the end, I'll show you a single figure on your own Centrelink record that most people overstate by tens of thousands of dollars, and you can fix it this week. And this works whether you're about to retire or you've been on the pension for 10 years already. Let me tell you where this started for me. Years ago, I sat across a desk from a couple in their late 60s, both born in the 1950s, both retired, both convinced they earned too much to get a pension. They'd been told that by a bloke at their bank. They'd accepted it. They walked away from money that was theirs for the taking for 3 years before anyone bothered to actually run the numbers. When I finally did, the silence in that room is something I've never forgotten. That was the day I stopped trusting the people who are supposed to explain this to you. So here's the first thing I need you to understand, because everything else hangs off it. Most people think the age pension is decided by your income. It isn't. There are two tests, and Centrelink runs both and pays you off whichever one gives you the lower pension. One is the income test, the other is the assets test. And for the vast majority of retirees who own their home and have a bit of super, it's the assets test that controls everything. That distinction matters more than almost anything else you'll hear today. Because once you know which test is the one squeezing you, you know exactly where to push back. Let me give you the real figures, the ones that sit in the fine print. A single homeowner can hold around $321,000 in assessable assets and still get the full age pension. Above that line, the pension doesn't stop, it tapers. And here's the part that nobody explains clearly. For every extra $1,000 in assessable assets above that threshold, your pension drops by $3 a fortnight. $3 a fortnight doesn't sound like much, does it? But run it out. $3 a fortnight is $78 a year. So every single $1,000 Centrelink counts against you above that line is quietly costing you $78 a year every year for the rest of your life. Now hold that number in your head, because this is where it gets uncomfortable. If Centrelink has counted $40,000 more in assets than you actually have, that's not a rounding error. That's roughly $3,000 a year walking out of your pocket. Over a 10-year retirement, that's $30,000. And the wildest part is, the most common place that mistake hides is in a number you wrote down yourself years ago and never looked at again. I'll come back to that. I promise you it's worth the wait. But before you can fix the assets side, you have to understand who benefits from you not understanding it. Because this confusion isn't an accident. The two-test system, the tapers, the thresholds that shift every March and September, the deeming rules layered on top, it's all complex enough that the average person simply gives up and accepts whatever the letter says. And when you give up, the system saves money. Every retiree who assumes they don't qualify and never applies is a saving on a spreadsheet in Canberra. Every pensioner who overstates their assets and never corrects it is paying a tax that nobody calls a tax. I watched this for years. The complexity isn't a bug. It's doing exactly what it was built to do. Let me show you the second place your money leaks, because this one had me genuinely angry when I first understood it. It's called deeming. Now, deeming is a word you've probably seen on a Centrelink letter and skated straight past. Here's what it actually means. When Centrelink works out your income from financial assets, your bank accounts, your shares, your account-based pensions, they don't look at what those investments actually earn. They pretend they apply an assumed rate of return, and they call it a deeming rate. They deem you to be earning a certain percentage, whether you really are or not. For years, the lower deeming rate has sat at 0.25% and the upper rate at 2.25%. The lower rate applies up to a threshold around $62,600 for a single, and the upper rate applies above that. Now think about what that means. For most retirees, the assets test is the binding one, so deeming sits in the background. But for plenty of people right on the edge between the two tests, that deeming rate is the difference between a part pension and nothing. And here's the kicker. Those rates were frozen back in 2020, and the freeze has been extended more than once. Whenever rates are low, that freeze helps you. But the moment the government decides to unfreeze them and lift those numbers, your deemed income jumps overnight and your pension can fall, even though your actual bank balance hasn't moved a single dollar. That's what I mean when I say the rules were never written in your favor. You can do everything right. Spend nothing extra, earn nothing more, and a decision made in a building you'll never enter can shrink your pension because of money the government has decided you're earning on paper that you might not be earning at all. The 2026 reviews and rate adjustments are exactly the kind of moment where this can shift under your feet. So you need to know your own numbers before the letter arrives, not after. Therefore, the single most powerful thing you can do is stop treating your Centrelink record as something that's set in stone. It isn't. It's a snapshot, and snapshots go stale. Your assets change, your account balances drop, the value of your car falls every year. And Centrelink does not automatically chase down the good news for you. They'll update the figures that increase your assets fast enough. But the figures that have fallen, the ones that would lift your pension, those sit there untouched until you pick up the phone and tell them, let me make that concrete, because this is something you can act on regardless of how long you've been retired. Centrelink values your assets at their current market value, not what you paid. That car you bought for $35,000 8 years ago isn't worth $35,000 anymore. It might be worth 12. But if you declared $35,000 when you first claimed and never updated it, Centrelink is still counting $35,000 against you. Remember the rule. Every $1,000 over your threshold costs you $78 a year. That overstated car alone could be quietly draining well over $1,000 a year from your pension for a car that's depreciated in your own driveway. Same goes for shares that have fallen. Same goes for managed funds. Same goes for the balance of your account-based pension, which you've been drawing down every year, so it's almost certainly lower now than the figure Centrelink has on file. Every one of those is a downward revaluation you are entitled to request. And here's what makes me shake my head. There's no special form, no advisor, no fee. You ring Centrelink or you log into your MyGov and you update the current values. That's it. The pension can be recalculated from there. People pay accountants hundreds of dollars for advice that boils down to this one free phone call. Now, I can almost hear what some of you are thinking. That's all well and good for someone about to retire, someone still arranging their affairs. But you've already retired. You've already drawn your pension for years. You've already filled in the forms and accepted the outcome. You think that ship has sailed. So let me speak directly to you for a moment, because this next part is built for exactly the person who assumes it's too late. It is not too late. In fact, the longer you've been retired, the more likely it is that your file is wrong in your favor and you've never claimed it back. Think about it. The more years that have passed, the more your car is appreciated, the more your super is drawn down, the more your declared household contents have aged into near worthlessness. Every one of those years is a year the gap between your real assets and your declared assets has been growing. And every one of those years, that gap has been costing you pension you were entitled to. You can't always get the back payment for years gone by, but you can stop the leak today, and you can stop it without anyone's permission but your own. Here's exactly what to do this week, and you need no advisor or no new investment to do any of it. Sit down and write a current, honest list of every asset Centrelink counts. Your bank accounts, today's real balances. Your super and account-based pension, today's real value, not the value from your original claim. Your shares and funds at today's price. Your car at what you'd actually get for it now. Look it up on a couple of car sale sites and use the lower figure. And your household contents, which we'll get to, because that's the big one. Then compare every line against what Centrelink currently has on record. Wherever your real figure is lower, that's pension you're owed going forward. Report it. Watch what happens to your next payment. And while you've got the file open, check one more thing that retirees miss constantly. The work bonus. If you do any paid work at all, even a few shifts, even some casual cash-in-hand consulting, the first $300 a fortnight of employment income is not counted under the income test. On top of that, there's a starting credit and an unused balance that builds up over time up to several $1,000s that lets you earn more without losing a cent of pension. People hear pension and assume any work destroys it. That's exactly the assumption the complexity wants you to make. The truth is, the system has a built-in allowance for you to earn, and most people never use it because nobody ever told them it was there. And that distinction, knowing exactly which lever is squeezing you, is something I've spent years trying to put into plain language, which is exactly why I wrote it all down. If you want every one of these rules, the assets test, the taper, the deeming thresholds, the work bonus, I put it all together in the pension blueprint, part of the complete senior money field edition. It's the guide I wish existed when I was sitting across from that couple who lost 3 years of pension because nobody explained the basics. You can find it linked in the description at david-aussie-seniors.com. And at $97, it costs less than an hour with an accountant who probably won't tell you half of what's in there. Everything in this video, and a great deal more that there simply isn't time for here, is laid out in plain language you can act on the same day you read it. Now, back to where that money actually leaks, because I told you at the start, there's one figure on your record that people overstate by tens of thousands of dollars, and fixing it is the single fastest way to lift your pension. So let me finally tell you what it is and where I found it buried. It's your household contents. Your furniture, your white goods, your telly, your clothes, your kitchen things, the tools in the shed. When you first claimed the pension, somewhere on that form, you had to put a value on all of it. And here's what almost everyone does. They think about what it would cost to replace it all. New lounge, new fridge, new washing machine, new beds. They tally it up in their head and they write down $40,000, $50,000, sometimes $60,000, because that's what it would cost to walk into a shop and buy it all again. That is the wrong number. And it's costing you a fortune. Here's the rule. Straight from the way Services Australia actually assesses it, and this is the part they do not put in big bold letters anywhere you'd notice. Your household contents are not valued at replacement cost. They are valued at their secondhand value, what you would actually get for them if you sold them today, garage sale value, fire sale value, the price a stranger would hand you for your 8-year-old couch and your scratched up dining table at a Saturday morning yard sale. So think about that, honestly. What would your entire household of secondhand furniture and appliances actually fetch if you had to sell the lot tomorrow? Not replace, sell. The real answer for most ordinary retirees is somewhere between $5,000 and $10,000, not 50. Your used lounge that costs $3,000 new is worth maybe $200 at a garage sale. Your fridge, $100. Your clothes, almost nothing. Nobody pays real money for secondhand clothes and worn linen. Now, bring back the rule that runs through this entire video. Every $1,000 of accessible assets above your threshold costs you $3 a fortnight, which is $78 a year. If you declared $50,000 of household contents at replacement value, and the real secondhand value is closer to $8,000, then you have been carrying $42,000 of phantom assets on your file. $42,000 that doesn't really exist, that you wrote down yourself in good faith because nobody told you the right way to value it. At $78 per thousand, that overstatement could be costing you well over $3,000 a year. Year after year after year. I want you to sit with that, because when I first traced this through the assessment rules, it stopped me cold. This isn't a loophole. It's not a trick. It's not gaming the system. It is the correct valuation method that the system itself uses, that simply never gets explained to the people filling in the form. The form asks for a value. It doesn't sit you down and explain that value means garage sale value, not shop value. And so millions of honest people who would never dream of fudging a number, overstate their own assets by tens of thousands of dollars and hand back pension they were entitled to keep. The honest ones lose the most. That's what got me. So here is precisely what to do. And you can do it this week with a phone call and 10 minutes of honest thinking. Walk through your home, room by room. For each item, ask yourself one question only. Not what did it cost? Not what would it cost to replace? Just this. What would a stranger actually pay me for this used today? Be honest, but be realistic. Worn things are worth little. Old appliances are worth little. Add it all up at that real secondhand value. For most people, that total lands far, far below what they originally declared. Then contact Centrelink and update your household contents to that correct current secondhand figure. There's no penalty for correcting it. You're not doing anything wrong. You're finally valuing it the way the rules say it should have been valued from day one. And here's why this matters so much more than people realize. Because household contents are assessed at this garage sale value, it is almost always the most overstated single line on a retiree's entire Centrelink file. It's the easiest one to get badly wrong because the instinct to think in replacement cost is so natural. Which means for most people, it's also the single biggest, fastest, no-cost correction available to lift their pension. No advisor, no investment, no risk. Just the right number finally written in the right box. Now, let me connect this back to everything, because once you see it, you can't unsee how the whole machine works. The assets test controls your pension for most homeowners. The taper takes $3 a fortnight for every $1,000 over the line. Deeming pretends you earn money you might not. And every one of these is wrapped in enough complexity that the natural human response is to shrug and accept the letter. But every figure on that file is a lever. The car you overvalued, the super you've drawn down, the shares that fell, the contents you priced at shop value instead of garage sale value. Push every one of those levers back to the truth, and your pension rises legally this week without you finding a single extra dollar. I think about that couple I mentioned at the start, the ones who walked away from 3 years of pension because a bloke at the bank told them they earned too much. They never even got to the assets test. They never knew it existed as a separate thing. They never knew their contents were wildly overstated. They just trusted the person in front of them the way you've probably trusted the letters and the phone staff and the forms. And the system rewarded that trust by quietly keeping what should have been theirs. That's the part I can't make peace with. Not the rules themselves, but the silence around them. The way the people who profit from your confusion are never the ones who have to explain it to you. So, before you do anything else, I want you to make a short list today while it's fresh. Write down 4 things. Your car's real value now. Your super and pension account's real balance now. The real garage sale value of your household contents, and whether you've ever once asked Centrelink to revalue any of it downward since the day you first claimed. If the answer to that last one is no, then I can almost promise you there is pension sitting on the table with your name on it, and it has been sitting there untouched for every year you didn't ask. The reviews and adjustments coming through 2026 are exactly the wrong time to have stale, overstated numbers on your file. Fix them before the next letter, not after. And let me leave you with the simplest version of everything. The one sentence I wish someone had said to me decades ago, before I watched too many good people lose what was theirs. The age pension is not charity, and it is not a favor. It is an entitlement you paid for across a lifetime of work and tax, and the figures that decide it are yours to keep honest and yours to correct. Nobody is going to walk into your home and tell you your couch is worth $200, not $50,000 in replacement cost. Nobody is going to ring you to say your car has depreciated and your pension should rise. That phone call only ever goes one direction unless you make it go the other way. You're clearly not the type to be quietly milked by a system that profits from your silence, or you'd have switched this off 10 minutes ago. You sat through the whole thing because some part of you always suspected the letters weren't telling you the full story. They weren't. Now you know where the money leaks, and you know exactly which numbers to fix first. So here's what I want from you, and I'm asking directly because this audience never tells me unless I ask. Go and look at the household contents figure on your own Centrelink record, then tell me in the comments below, what did you originally declare and how far off do you reckon the real garage sale value is now? I read these, and I promise you, you are not the only one who's been carrying a phantom number for years. While you're there, tell me which part of Australia you're watching from. I like knowing where these warnings are landing. And if you've had enough of finding out years too late about money that was always yours, subscribe and stand with the rest of us who've decided to stop being quiet about it. Because next time I'm pulling apart something just as buried, the gifting rules, and the exact way you can move money out of your assessable total in the months before review without tripping a single Centrelink alarm. Most people get the timing wrong and lose the benefit completely. I'll show you how to get it right. Don't let another letter arrive while your file still works against you. Check those numbers this week. The pension you take back might be the one you've been quietly handing over all along. Before you close this off, let me give you one more thing to check while you've got that file open, because it sits right alongside the contents figure and it catches people just as often. Your funeral bond, or your prepaid funeral. If you've set aside money for your own funeral, and a lot of you have, there's an exemption that means up to a certain amount is not counted as an assessable asset at all. A prepaid funeral paid in full is fully exempt. A funeral bond up to the allowable limit, around $15,500, is exempt too. But I've seen people declare that money as a plain savings account, sitting in their assessable total, dragging their pension down when it should have been carved out entirely. That's another phantom figure quietly costing you $78 a year for every $1,000 it shouldn't be there. And here's the thread that ties all of it together. Every single one of these corrections, the contents, the car, the drawn down super, the funeral bond, none of them requires you to spend $1, sell a thing, or change how you live. You are not getting wealthier. You are simply telling the truth more accurately than the form ever let you. That is the whole game. The system was built so that the easy mistakes all run in its favor and the corrections all have to come from you. Once you understand that, you stop waiting for the letter to be fair and you start checking it yourself. So promise me one thing. Don't let this be another video you nod along to and forget by Thursday. Pick up the phone this week, walk the rooms, write the honest numbers, log into MyGov. Because the difference between knowing this and acting on it is measured in real dollars, landing in your account every fortnight for the rest of your life. The knowledge was always there, buried under the complexity. Now it's yours. Go and use it before they update the rules again.